For some time, China has been secretly stockpiling massive amounts of critical and strategic resources. Some military analysts believe de-dollarization, Taiwan, the transition to green energy, and China's stockpiling of gold, silver, and other resources are all interrelated. But one puzzling aspect of China's secretive silver acquisition has been the lack of impact on the spot price of silver. Finally, we have the answer as to how China is avoiding impacting spot prices, why they're doing it, and what the implications are for the rest of us. We are going to jump straight into the heart of the matter. Spot prices for commodities like gold and silver are determined by trades that occur on global exchanges, such as the COMEX or the LBMA. Any refined silver transacted through these exchanges contributes to the spot price. When large purchases are made on these exchanges, they can lead to a noticeable impact on price due to the significant demand being registered in an open, transparent, and public market. But what about silver bought and sold off the exchanges? Because a private confidential transaction is not recorded in the exchange, it does not directly contribute to the spot prices. And it is even more true if the silver being purchased is from a nation with less regulations, perhaps in Africa or South America, and the silver is not refined but instead sold as unrefined silver concentrate. This is exactly what China is doing. They're going to miners and refiners and entering confidential, long-term contracts to purchase silver at fixed prices. Once the silver is purchased from the mine, it is sent to a refinery. From there, pure silver is delivered to China. An entire supply chain created in secret that circumvents the existing system with a great deal of effort. But why go through the trouble? This is what's known as an impact avoidance strategy. If China purchased large quantities of refined silver directly from the exchanges, spot markets would react. The price of silver would rise sharply in response to demand, making it more expensive for China to accrue the silver stockpile they need for their goals. It could also create market panic or speculation and lead to international backlash, especially as the stockpiling strategy for China is believed to be related to other geopolitical objectives. If nations internationally were to suddenly see an increase in their silver prices and see what China's doing, there could be interference. China will want to avoid that. We've covered this in other videos, but there is also concern that China is preparing to invade Taiwan within the next few years among military analysts. The stockpiling of critical resources and de-dollarization initiatives appear to be related. China believes that Taiwan is a part of China, and reunification is a central tenet of their policy. The best way to think of this situation is to reimagine the US Civil War. If the South had lost but retreated to Hawaii, claimed it as Confederate America, and continued to govern, you would have a reasonable analogy. However, Taiwan has governed itself independently as a democracy for 75 years, since the end of the Chinese Civil War. The people there have their own identity, and most of the world understands that they have become truly separate as the years have passed. An invasion of Taiwan would result in international backlash. Had China acted promptly in the years after the Chinese Civil War, the world would have viewed it as an internal matter, but that window of opportunity passed decades ago. It's likely the US would react with sanctions intended to cripple China economically, similar to what Russia endured in the aftermath of their Ukrainian invasion. And this is where silver stockpiling, de-dollarization, Taiwan, and the green energy transition intersect. If China were to invade Taiwan and suffer the impact of US sanctions, it could greatly harm their ability to import necessary commodities. While China is a net exporter of electronics, machinery, chemicals, textiles, and more, they are a net importer of some critical items. Coal, which is the dominant fuel used to generate electricity in mainland China, and food to feed their billions of citizens. China cannot hope to invade Taiwan and pursue an agenda of reunification without the threat of sanctions and military interference from other nations straining their country in critical areas. To mitigate the issue, China can stockpile necessary materials and pursue an agenda of de-dollarization. China's not just stockpiling silver, they are also stockpiling other critical resources. In 2023, China increased its imports of food and coal by over 60% from the prior year, for example. And they can also decrease reliance on coal by building new energy infrastructure. China is the global leader in nuclear reactor construction, with approximately 24 units under construction, and they are a global leader in solar panel production, which requires massive quantities of silver. So we've come full circle, and China's motives explain why they are acquiring silver in the manner they are, but what's the net impact on silver spot? With hidden demand, the spot price is largely unaffected in the short term, but there are some long-term impacts. First, there is reduced market liquidity. With less silver available on open markets like the COMEX and a shortage of over 1 billion ounces of silver from the past 5 years of excess silver demand outstripping supply, we expect to see tighter liquidity. This can result in greater volatility of spot prices over time. If China's direct purchases create a significant supply-demand imbalance in global markets, scarcity could create upward pressure on prices. This would be more likely to occur if large silver purchasers were suddenly unable to fulfill their orders through their usual channels. And finally, this could eventually lead to a decoupling between the paper and physical silver markets. When physical silver is priced higher than silver futures, it's called backwardation. Normally in commodities markets, futures prices are higher than spot prices, a condition called contango. In contango markets, traders expect that commodities will be more expensive in the future, which is commonly the case in markets with ample supply and steady demand. Backwardation occurs when the market is stressed due to conditions like supply shocks. Viewers need only look to the palladium market in 2018 to get an idea of what's possible. With limited mining supply of palladium and years of shortages depleting above-ground stocks, the palladium market eventually entered backwardation. Prices spiked due to tight physical supply, and volatility dramatically increased from historical norms. An investor holding onto palladium from 2016 may have enjoyed the ride, as an ounce of palladium rose from about $950 in 2018 to a peak of $3,440 in 2022. The shortages drove an increase of more than 300%. That'd be like seeing silver rise from $30 to over $90 per troy ounce in a few short years. Silver is a finite resource. If demand continues to outpace supply, we will eventually deplete above-ground stocks. Countries like China that are successfully subverting the existing system will only increase the odds of creating a global supply shortage. But it's also possible that demand abates for silver before our existing supplies are consumed, or that new sources enter the market and increase the supply. With little resistance from global entities and other countries, all we can do is wait and see what unfolds. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.